Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started.
Good day, trader. Stacey Burke from Stacey Burke Trading. Today we're going to be talking about targeting high probability explosive trade opportunities. So we had a non-farm payrolls week. We had some other major news on the calendar, but we're going to take a big picture perspective on identifying the best instrument in the session that you're trading. Still, traders emailing, asking questions about why certain instruments didn't play out, and still getting stuck on just following one or two instruments and trying to curve fit your trades every session to that one or two instruments. So again, my approach is to look for easy money opportunities on a basket of instruments. I don't care what it is. I want to look for the easiest setup that I can find in the session that I'm trading, which is predominantly the New York session. But I want to come back to the bigger picture and just a simple understanding each day of what I am looking for. I keep harping on the process and understanding the basics and the key things about all of this because it all boils back to the same things, and each day builds on the next, and you can build a thesis each and every day for each session looking for the highest probability opportunities. And again, I talk about looking for the money laying over on the corner, as Jim Rogers says it, and all you need to do is walk over and pick it up. I'm not trying to figure out a direction or predict where something's going. I'm looking for easy stuff. And when it's easy, it's simple and it's low stress, and you can scale those up in size. So again, coming back to the process and being able to walk through no matter what day of the week it is and be able to understand a simple thing each and every day of where I can filter down pairs right away to look for the best trading setups. People email me and say, well, yeah, but you don't look at the daily, you don't look at the 4-hour, you don't look at this, you don't look at that. You're missing the big picture. So hopefully this will help to just cement that down a bit. These blue lines represent previous daily highs and lows. Now, everything is fractal, and we talk about the timing of a new month, a new week, a new day, and a new hour. The goal is always to buy low and sell high, or to sell high and buy low. So these lines representing daily highs and lows, if you can just stop and look at them for a second and just think to yourself, if my goal each day is either to buy the low and sell the high, or sell the high and buy the low, I want to look for an opportunity in the session that I'm trading that is set up properly for me to be able to do that on any given day on any instrument. So if I look at an instrument and I'm caught inside, that's a low probability day for me in terms of having a best high probability trading setup. But if I come to a day or a week where I have broken out of a weekly high in the Asian session and I've gone 3 levels of rise above that, I may potentially have an opportunity in the session that I'm trading for maybe a short trade opportunity outside of the weekly range. Or in the next day itself, if I have a failed breakout because of a market that's taken out a weekly high or a daily high and failed, I may have an opportunity now heading into the next day in the Asian session, or maybe even in the London session, for a low-hanging fruit continuation opportunity. So in terms of understanding asymmetrical risk reward, I'm always looking for where the market is giving me a chance to either buy low and sell high, or sell high and buy low. It's as simple as that. So in this video, we'll look at how non-farm payrolls played out on the Friday and why certain instruments have set up a certain way in terms of session opportunities. But we'll look at the non-farm payrolls on the US dollar crosses. I had several traders email me asking me about the US Canadian day 3 longs in the market, why it didn't play out, and we're going to talk about that. When I trade the US dollar cross, I'm always looking at the US yen, the US Swiss, the US CAD, those three, and then targeting one of those, if I have an ideal best trade set up, which one's going to give me the easiest money? I'm trading the US dollar, so I want to know if I'm going to short it, which one is set up to be the weakest in terms of me making easy money, not me trying to curve fit a strategy to one instrument. So let's walk ourselves through that. This week is a non-farm payrolls week. We have a market. We'll talk about the opening range and the initial balance, but we have our high-low of the previous week. So for traders who are thinking about looking at daily charts, weekly charts, here's my weekly high and low right there. There's my week. There's my weekly time frame. Now, if we walk ourselves back, we already know that weekly long traders are in the market on breakouts. We can walk all the way back to the beginning of the year in terms of the monthly cycle. So we have a new month. January puts the high and low in place. February breaks out. We have month one longs in the market. We get into March and we still have weekly longs in the market. March starts and we have month 3 longs in the market. Month 2 longs in the market. So we have our weekly high broken. But let's come back to our opening range on Monday this week. Pink line separates Friday, Monday. We have our high low on Monday. We won't even talk about Monday trying to trade the yen. We're just going to talk about the process. We have our weekly high low in place. No weekly levels have been broken on Monday. And we go into Tuesday, and at the Asian and Europe London session, we do not have a breakout of our opening range. Now, we won't talk about buy low in Europe or anything else. We'll just talk about the opening range. We have a market that has set a high and low for the beginning of the week. We haven't broken out of any weekly levels. But as we head into the U.S. session, we had U.S. news, 10 a.m. New York time. The market breaks out of our opening range. And we talk about the initial balance by Monday, Tuesday. One of those extremes typically will tend to hold as a high or low level for the week in 80% or more of the time. So we have a breakout of our opening range that obviously gave traders maybe a first bounce opportunity. Not even worried about that. We're just going to walk through the process. So number one, on Monday, if our risk reward is the high low of the previous day, we're not even talking about the high low of the week. We're inside of a range. We have a market that breaks the low of Friday, but it doesn't give a buy low opportunity in the US window. Traders in the Europe London window obviously had a session trade that took out the high of the day. So again, understanding the difference between 5-star versus 3-star, 2-star, 1-star, that's a session trade. Takes out the high of the day, goes into consolidation before pulling back. But our opening range breakout does not occur until Tuesday's US session. We now have an opening range breakout that continues, and we have day one longs in the market, and the market closes out of balance. Remember what we talked about in our previous video. You can go back to the last video. Dalton, when a market goes out of balance, it has the greatest risk and the greatest opportunity. So let's just take this now and talk about range expansions. So we have a market that has done one full range expansion and potentially now may do 2 full range expansions. It breaks out on our Wednesday, which is our day 3, day 1, day 2, day 3. So we may have a day 3, 3-day setup. We have day 1 longs in the market. Now we have day 2 longs in the market, and we have gone 3 levels of rise outside of the high of the week and the high of the day for a possible high of the day, high of the session, short trade opportunity, maybe in the Europe-London window. We get that, and we get a low-hanging fruit continuation trade in the U.S. session that gives us a failed breakout at the high of the week. Not only the high of the day, the high of the week, and the high of the previous week. We now have done 2 full range expansions of our opening range and initial balance on an opening range breakout. And in the Asian session, traders who were astute to that had an opportunity for a high of session, high of day shorting opportunity in the Asian session.
which also gave a low-hanging fruit short trade continuation in the London window. We now have day one shorts in the market. But let's come back just to looking at the box again while we're in this process. When we come to the next day in the Asian session, we have our asymmetrical risk reward, our box for selling high or buying low. Now, if I want to sell it up here, but I can't because the market doesn't give me the chance to sell it up there, my next best opportunity, if I cannot sell the high of the day, write this down, is I want to sell the high of the session. Now, if I can't get an opportunity to sell the high of the session because it doesn't go to the high, it's already in there when the session starts, my next best opportunity perhaps is the high of the hour if it gives me the pump and dump shorting opportunity to sell it in that Asian window. We'll go back and look at this in a moment, but I want to walk through the process. This is my high-low. The breakout of the previous day has failed. That level now that we broke out of and failed, that level now is my new potential area of shorting in the high of the box, the high of the session, the high of the day, the high of the hour, if I get that opportunity for my short trade setup. That's asymmetrical risk reward. Selling high and buying low. Whether I buy at the low of the session, the low of the day, wherever it is, wherever my exit criteria tells me to get out of the market and lock that money in. Now in the London session, when we get our shorting opportunity, again, where we broke out of could potentially be an area on that Tuesday, the opening range breakout, for me to, if I was shorting high or shorting in the high of the London session, to lock in the money and get off the screen for the session that I'm trading. So we're talking about non-farm payrolls, and this is, again, the criteria. I have a market that's broken out of the high of the week and failed. We have a market that has put a low of the week in place on our current week. Our initial balance low is on the Tuesday, Monday, Tuesday, gave a higher low. That is our most recent reference point as the low of the week. And we have the low of the previous week. If we have a failed breakout at the high of the week, again, coming back to asymmetrical risk reward, I want to buy the low of a day and sell the high of the day, or sell the high of the week and buy the low of the week, or sell the high of the week and buy the low of the day. Whatever those criteria are, I still want to sell high and buy low. And so these areas are my reference points each and every day for forming my thesis and my bias. So we have a market that's failed on a breakout, and coming into our non-farm payrolls, we have a high and a low box from the previous day's high-low, but we have our failed breakout high of the day level as our box for either selling high or buying low, heading into non-farm payrolls. Now on the day itself, BOJ obviously gave a large wick volatility. Traders have asked what I do with that. Typically, I do not do anything on the yen pairs until that BOJ releases their tentative statements, whatever that is. When it coincides with the payrolls, I don't really do anything anyways, because I don't do anything until I come to the screen for the U.S. session. But that gives us a high of the day. Before our non-farm payrolls, we have a new low of the day because the market traded down slightly lower, so we redraw our levels. So coming into payrolls, we have a high of the day and a low of the day. Heading into our U.S. session, the market has broken down on the inside. Broken down on the inside means it's taken out these lows. So it's made a lower low on the inside, and that is the possible formula now in a market that has a failed breakout on the inside for the pump and dump setup heading into non-farm payrolls. Now we're going to compare this to the Swiss franc and the Canadian dollar to identify why certain pairs, again, if we're trying to identify one out of the three as a best trade candidate, how we could form our thesis to pick one or two out of those pairs to trade.
Now, coming into non-farm payrolls, if my thesis was this market is going to target the low of the week, we have a pump and dump scenario, but we're going to wait for payrolls to either explode and coil and give us a first bounce continuation, or do nothing or wick or explode and completely reject that thesis and go vertical through the high of the day. Gives us our universal entry criteria right out of the playbook from our page 29 in the playbook. So again, coming back to the understanding, I don't have the opportunity to sell the high of the day. I don't have the opportunity to sell the high of a first bounce opportunity, but I do have the opportunity now to sell the high of the hour in a market potentially targeting the low of the week. Okay, remember the low of our week from the failed breakout is down under that 135.25 area. We have a simple, low stress, easy trade following through on the original thesis of a failed breakout from the high of the week, targeting the low of the week for an easy, low stress trade opportunity. So if we compare that to the Swiss franc, if we start our week off, and again, we have our weekly levels drawn right off the bat before the week starts. So for traders who think I'm only stuck on the 1 minute chart, you have to understand we're targeting asymmetrical risk reward on the larger time frames. So it's easy to step back and know whether you're inside looking at chop thinking there's a trade versus a market that's set up in a 3-day setup or a breakout because it's out of balance and now we have uncertainty in the market. And when there's uncertainty, there's greater risk and greater opportunity. But being able to form a thesis based on that. So right off the bat on Monday, we have, if we go back and draw our little box, there's our high-low for our asymmetrical risk reward. We have a market that breaks out on Monday from the low of the week. Now, my question then is, as always, who is in the market? We have short traders in the market on day one of the Swiss franc. So shorts are in the market. Now, we've talked about, the market was moving up, going higher, triggering weekly longs right at the beginning of the market. Right off the bat, when they trigger a weekly higher low on the first day or even the second day, you need to be thinking to yourself, potential false break, or even on a Friday for a dump and pump or a pump and pump. They trigger traders into the market right away, trapping them on the wrong side or putting heat into them right away. They get triggered breakouts into the market. But let's go back. The market breaks down. We have day one shorts in the market on the new week at the low of the week. But there's our opening range. Tuesday, we have an opening range breakout trade triggered. We have shorts, day two shorts in the new week. So forget about everything else. Just there's our high low of the week, but we have day one shorts in the market at the low of the week. And we have an opening range breakout in our Asian session that triggers short traders into the market that reverses back inside in the London session and trades all the way back to the other side of the day from our opening range on the Monday. So again, remember 80% of the time, opening range initial balance will set the high and low for the week. And in a large percentage of cases, one of those will tend to hold. So we have a failed breakout now at the beginning of our week on our day two, but our initial balance doesn't close until up top, and we have day one longs in the market. Day one longs in the market, we have a new low of the week. And on our Wednesday, day three, we get day two longs triggered into the market. That breaks out of the high, does not take out the high of the week before closing as a first red day. Now, this doesn't fit the textbook definition of a first red day because the close is still above the open, but the behavior of this potentially may, because we had major red news in our U.S. session that spiked both sides. So for all intents and purposes, we won't call that a textbook first red day because the close is roughly just slightly above the open. But the behavior of this, having the failed breakout on day three inside of that previous week's high, which if we come back and look at that, this is again an hourly chart.
the high of the previous week was itself a failed breakout also. So this level may have some significance up around that 9,400 level. 25 pips above 9,400 seems to be holding as a significant level of selling. We've got shorts trapped down low at the low of the week, but we've made a lower low inside. Lower low inside on Monday, Tuesday may potentially now be our break in structure and the setup for the pump and dump. So we head into our next day, and there's our box up top. We'll flip this up. There's our high-low box, but we're in a market that now has a failed breakout heading into our Thursday that breaks down again on the inside. So our box then becomes the low of Tuesday and the low of Wednesday, because we've broken down, and this area now is a potential level of selling, which gave a low-hanging fruit continuation trade on the inside after the failed breakout. Lower lows, lower highs, the trend is on the inside. We have pump and dump setups working their way back down now in our US session inside, and our potential target now is the low of the week. So coming into our non-farm payrolls Friday, again, just looking at this pair and then being able to go through the process if you're targeting a short trade or an opportunity for payrolls on the US dollar crosses. Now, remember, I have no idea what the market's going to do, and I'm coming in the US session. I'm just forming my thesis, and I can't do anything until after payrolls is released, because payrolls could go bang. I don't know. I have no idea. But my underlying bias at this stage heading into the US session is I have a market that's broken out of the low of the week and continues to make lower lows and lower highs. We go to our 5-minute chart and our 1-minute chart for the first bounce opportunity. Now, some traders asked about if this was a first bounce opportunity. Now, let's talk about this so we can say that we, given devil's advocate, that this was a first bounce trade. So I want traders to understand that if you took this trade, no problem. But this is where you need to understand how a momentum trade should behave. A momentum news catalyst trade should continue to move fairly strongly in the direction of that bias after the news is released, if indeed it has the momentum and the news catalyst behavior behind it. So if you're in this trade, and let's say you've entered in 4 minutes into this trade, 5 minutes into this trade, this market is auctioning sideways and we're into the new 15-minute candle now. So we're 15 minutes later. So we're into the new 15-minute candle, and you still haven't got 25 pips. If this market reversed like this, I'd be out of that trade, completely closing that down. So in terms of trade management, understand the timing. 15-minute cycle ends, a new 15-minute bar starts and engulfs and reverses. 3 minutes in, okay, break even, close the trade, whatever. That has not followed through. So remember, a first bounce opportunity should be working its way fairly consistently in the direction of that momentum blast and continue the move right away. You had 15 minutes to be at break even here, and you still did not have 25 pips of profit. That is not a news momentum follow through first bounce trade opportunity. So if you did take this in terms of trade management, you need to be thinking, okay, this didn't follow through, I'm out of the trade. Now we go back to our original trade thesis. Payrolls is over now. So now I go back to work. I go back to doing my job, which is to look for the easy trade, and we get our 5-minute universal entry criteria is met in the new hour. If I can't sell the high of the day or the high of the week, I want to then sell the high of the session. I didn't get that chance because I couldn't get in. Because if I got in, if I took this trade at the high of the session before payrolls, what if payrolls went bang first and then bang? So traders say, well, yeah, but I had a stop in place. Except that
as I talked about, you could have a stop right here. But when they lift the offers and pull the bids, your stop loss will get hit, probably at best, if they wick it, 50 pips away from where your stop is in some cases. So there's no need to be gambling, speculating, taking high risk. That's not part of my playbook. That is not part of my playbook. But this trade, the easy, low stress, low hanging fruit, universal entry criteria, 5-minute entry into an already broken down market, is part of my playbook. And this is the easy trade for 2 full range expansions. And again, all you need to do is take the high low of where the most recent wick fails. So we get a wick, and it's simple. It's really typically simple as looking at 50 to 60 pips. This is a 25 pip box. We get 2 full range expansions. The market then creeps into that low. We're out of the trade. There's 60. Fill on this trade was roughly 92.41. We're looking at an area in the neighborhood, 91.80 plus 5 pips. I'll add 5 pips off of that level just in case it wicks down as it did. With the spread, it takes me out, and we're looking at 50 to 60 pips. So 50 is obviously an expected area in this particular case. If I can get more out of that, I'll obviously try to squeak 5 or 6 more, or maybe 10 more pips out of that trade. And we're done. We're out of the market. That gave us an easy, low stress continuation trade after the news with a 1-bar stop and our risk on this trade. And again, the wick on this, I wouldn't even consider that because this should follow through immediately as it did. So the high bar on this candle is 92.61. Our close entry is 92.41. I would be putting a 15 pip stop on this trade because this market should collapse down through. There shouldn't be any more auction process back up. The news is over. We have our stop loss in place. If you want to put the stop at the high of that wick, it's completely acceptable. It doesn't matter. But this market should now behave in line with the direction of our underlying bias. Which brings us to the Canadian dollar. So, coming back to the process, we have a market that broke out. We'll go back and just start from our opening range. And we talk about the box each day. On Monday, we have a box, a high-low box. I'll just make this our box area. If I want to buy low and sell high, I didn't get that chance on Monday. It's an inside day. But we come to we'll bring our opening range across, and in the U.S. session, the market has an opening range breakout and explodes outside of our weekly high-low levels in the process. So you'll notice that Friday's low, I had several traders say that's not the low, that's not day one, it didn't break out the low of the week. When this breaks out on our Tuesday, when we get a breakout of Monday's high on Tuesday and the Friday's high, this is now our day one. Failed breakout at the low of Friday. Once they break the high of the Monday's opening range and the high of Friday, this confirms that this is our day one. That's the low of the week, the most recent failed breakout into our new week. Day one, day two, day three now breaks out, and we get 2 full range expansions. Okay, opening range, initial balance, our Friday, Monday, we'll bring this back down. There's our Monday opening range. We get 2 full range expansions as a potential profit target, but we now have a market that's out of balance and day one longs in the market. And we have weekly levels broken. On our Wednesday, we get day 2 longs triggered into the market. Day 2 longs are now in the market, and that market closes out of balance as well. You'll notice that as this market's going higher, okay, it continues to go higher into our Wednesday before dropping back. That's the real high. So even though we've taken out the high of the day, we've triggered day 2 longs in the market, this market is going up and then pulls back. So that level to me now is a breakout level. Because remember, each day we're going to be targeting a new box. We come to our Thursday, and the market trades back inside from high to low inside of our range before breaking down and reversing inside of our breakout high. And this leads us into our payrolls Friday. We had traders who recognized day 3 longs in the market. Day 3 longs in the market, which is a potential trading opportunity if it sets up for reversal trades. Day 3 longs in the market, and our box again, if this is our high-low box, we want to sell high and buy low. This is a potential opportunity for maybe a day 3 reversal opportunity. So we see that traders potentially had an opportunity for shorting high up major round numbers and getting a session scalp in the London window. So it didn't follow through to the low of the day. It followed through to the low of the session before pulling back. So again, traders who recognize this were locking in some profits, hopefully. It eventually broke down on the inside. And made lower lows and lower highs and potentially has a failed breakout, maybe giving us the day 3 shorting opportunity at the high of our box. So remember, asymmetrical risk reward, selling high and buying low, or buying low and selling high. We're looking at our day 3 reversal opportunity. Except, hold on, we have non-farm payrolls. So the entry on this trade setup came right at the end of the first 15-minute bar for our 5-minute universal entry criteria for our day 3 reversal opportunity that potentially now is going to give traders, you'll notice again the numbers, so the pump and dump above the quarter level. So remember what I say. Once you've got your thesis in place, we have our engulfment of the open of our high bull. I'm getting in at the level. I want to get filled above or better than the level if the market gives me that opportunity. Except I can't take this trade. Because payrolls is about to be released. So let's say, yes, it played out and gave 50 pips. Except that what if payrolls again went bang and took out the high of the week first before coming back down? So you're right, except that you got a 50 pip stop loss. Now, here's my next question. How much money do you want to lose? Because it all comes back to size. It's not about predicting and direction and getting 100 pips. It's about me finding the best trade setups and rinse and repeating them and getting them up to size. Sizing in. This is an easy, low stress, 50 pip trade. No problem. Easy money, except I can't take it because of non-farm payrolls. So coming back to our first bounce opportunity. We did not get a first bounce opportunity. Now, if you took this trade, coming back to looking at this chart, we have an area that potentially could become resistance. That's our 3-session setup, US, Asia, London. It breaks down inside this area down at level 7, the quarter level, inside of the previous US session low, 3 pushes and a reversal. In a rising market, okay, we have no break in structure, higher highs, higher lows. Compare that to the US Swiss. Okay, we have the yen already broken down. It's already broken down inside. And the US Swiss, it's broken down and broken out. We have a market out of balance already broken down versus the Canadian dollar. Higher highs, higher lows. Now remember, the only trading setup I have on this pair is day 3 longs in the market. That trade, if you traded first bounce, has given 50 pips. So there is no first bounce here, by the way. There is no first bounce. But if you traded this, you are selling this into the low of the US session. So again, if you were in this and you were looking for some sort of continuation on this engulfment in the next 15-minute cycle, understanding timing, so you're shorting this on what you perceive as a first bounce, down low, you had 15 minutes to get out of this trade. Now, come back to some basic understanding about first bounce. If we look at this chart, if the market, and we'll go to a 15-minute, if the market had exploded down through the low of the day, then coiled and gave a first bounce, we then may potentially have had a continuation opportunity. If indeed it exploded out first in that first minute, pulled back and gave you the first bounce coil, now we may have had an opportunity. But understand, there is no first bounce trade there. We have higher lows. We have no break in structure. But comparing that to the other two markets, we have broken down markets. So if we're selling something, I want to sell weakness. If I'm buying something, I want to buy strength. So I'll just compare that briefly to oil, and then you can go and study these and look at your charts yourself. So we had day 3 shorts in the market at the close of Thursday evening on oil. Spot crude, West Texas, doesn't matter. They're all trade very similar. This is an hourly chart, so we had a failed breakout at the high of the week. The market traded down into the low of the week. Thursday had day 3 shorts in the market, day 1 on Tuesday, day 2 on Wednesday. And I mentioned that this potentially, this higher high on the inside may potentially be our break in structure for setting up for a reversal opportunity that may evolve over the next few days. Over the day, we've broken the low of the week from the previous week, and we have day 3 shorts in the market. Now we have day 4 shorts in the market. And if we, again, just use common sense and identify where is our box for potential failed breakouts or high, buying low and selling high, comparing this to the Canadian dollar, we have our non-farm payrolls release. We've already taken out the low of the week. We'll zoom in here. We have a first bounce opportunity at the low of the box, targeting the breakout area from our day 3 shorts that triggered day 4 shorts that took out the low of the week, an explosive pin engulfment, and then our first bounce continuation anywhere in here that fits our criteria on the first bounce trade. Okay, first bounce trade, you need a 15-minute setup. Our 15-minute setup is day 3 shorts trapped in the market, and we are buying at the low of our box, targeting the minimum, which is the breakout low, which is potentially now the new high of our box, for 70 plus pips in under 10 minutes. That is how this should behave. So if you're in this trade on the first bounce, which several traders hit the oil trade, congratulations. If you're in this trade, that is a news catalyst, momentum follow through for easy money. So remember, if you're in a trade that you perceive as first bounce and it does not follow through almost immediately, as I say specifically in the first bounce criteria, if it does not follow through almost immediately, I am almost willing to cut the trade. It should follow through with an explosive follow through. Remember, let's zoom back out. We have breakout traders. We'll go to the 5-minute here. Breakout traders already in the market. Day 3, look at the space. They've brought everybody down low. There's a reason for that. Bang. That's how that should behave. Right back to that level. Now we've closed back inside. We're back in balance. And the potential target, I have no idea what this will do. It'll all come back to whether or not I have a setup when I come to the screen on Monday. I may wake up and it may have already taken that out. I have no idea. But that is how a first bounce opportunity should behave. So comparing this to the Canadian dollar, day 3 longs in the market versus day 3 shorts on oil, and how that's set up after payrolls. The Canadian dollar blew off and completed the day 3 long reversal opportunity, but we couldn't take that trade because non-farm payrolls put us at risk. So again, coming back and comparing those 3 and walking through the process and being able to form a thesis each session, understanding the high and low box, not the junk inside. Not the junk inside. So if you're trading inside, then that's not part of the playbook unless you were part of an existing trade from one side of the box to the other. So hopefully you got value from that video today, traders. Walk yourself through the process. Be able to understand each day asymmetrical risk reward and whether or not you're inside, whether or not you're on the for your session, if that market is giving you the opportunity, and then look through the basket of your instruments for which one may be set up for the easiest, best trade setup. Explosive, easy money, low stress. Lock it in, get off the screen. Keep it simple, traders. Enjoy your day. 1% better every single day, and may the markets go with you.